Hey everybody, hope you're doing well today. Well, let's take a look at the supply of money and interest rates and work to understand their connection. And should be a pretty short video, and I think it'll sort of lock into your mind and make a lot of sense very quickly. Here we go. Okay, first of all, the money supply. The money supply changes interest rates. It's something to really get into your mind. Like the supply of money is determined by the central bank, and the central bank more or less knows what the demand for money is. And so they can manipulate the money supply in various ways, and as a result, it's going to change the interest rate. And I think the impact of this is fairly obvious. They are related to one another. If the government decides, or the central banks, to show some sort of contractionary monetary policy, that'll mean there'll be less money in the system, which equals a higher interest rate, right? So the supply of money will move inward, and as a result of that, it will result in a higher interest rate. If they decide to expand the money supply or practice something called expansionary monetary policy, there'll be more money circulating around, and as a result of a simple supply and demand for money graph, there's going to be a lower interest rate. So let's take a look at the graph, and I think it'll make really a lot more sense, and you'll be able to grab it pretty quickly. Here we go. So here's a simple money market graph, right? Here's the supply of money. It's perfectly inelastic because the government is actually deciding. It doesn't respond to interest rates, but rather sets interest rates by controlling the supply of money. And so if you just look really quickly, if all of a sudden the government were going to say, hey, we're going to cut the money supply using the various ways in which it can, and stay tuned for future videos so that you know what that is. But here is SM1, so it moved in. Well, what if the bank wanted to expand an expansionary monetary policy? Here is SM2. Well, what's going to happen? All you got to do is look at where the new intercept is on the, the new intercept is on the demand curve, and you can see that interest rates, if they do expansionary monetary policy, are going to go down. And if they do contractionary fiscal policy, which is monetary policy rather, which is to contract the money supply, then interest rates will go up. And that makes sense to us because we know about supply and demand. So if I were to clean this graph up, it would look like that, right? Changes in the money supply will result in a change of interest rates. So to put it in like more economic-y terms, an action by the central bank which causes the money supply to increase outward. So money is going to be increased from SM to SM3 will cause interest rates to what? Fall as a result of the new intercept. And that would be an example of expansionary monetary policy. But if banks were to take some sort of action which would cause the money supply to decrease from SM to SM2, what's going to happen? Oh, check it out. Super logical. It's going to drive up the price of money, right? And the new interest rate is going to be IR2. And this we would call contractionary monetary policy. And that, my friends, is it. It's super straightforward. The money supply is being dictated, and the money supply, remember, is not just, it's the amount of money that's cruising around in the economy. And there are three main ways that the central bank can do that, and we'll talk about those in future videos. But I just want you to get the basic idea that if central banks cut the supply of money, it's going to drive interest rates up. If they increase the supply of money, interest rates will fall. Expansionary, outward movement; contractionary, inward movement. And if you got that in your mind, you are golden. All right? Monetary policy can be super confusing, but if you layer it in little by little by little, you'll see that you already have all the skills you need to understand so much of what's going on. You just have to get comfortable with these new graphs, which are really just basic microeconomic supply and demand graphs in disguise. All right, my friends, I hope you found this video to be helpful. We'll talk to you in a bit.